Dear investors, in this edition of Market Outlook, we would cover China opening up and its impact, Indian macros, budgetary expectation, our investing themes and valuations. On the first topic, China reopening and FPIs realigning their portfolios. In the recent past, despite a COVID flare-up concerns, we have seen China continuing to open up. And with it, the COVID scare has also receded. With China opening up, commodity prices such as steel and oil, which were soft earlier, have again strengthened. And stocks of commodity producing businesses have started to perform better. During the past year, India had seen strong FPI outflows at the beginning of the year, but as Russia-Ukraine conflict grew in intensity and China cracked down on its tech companies, two large emerging markets, the investors shunned these markets and India benefited at the margin. Now, as China is opening up and its markets are performing better, we are of course seeing some realignment of investors from other emerging markets towards China, and India is also seeing some amount of outflow. The realignment-led FPI selling seen in the country can prove to be a good entry point for domestic investors whose flows are more structural and would benefit once FPI selling subsides. The second point, Indian macros are strong. After a sharp dip seen in the level of forex, India's forex reserves have seen an uptick. This has been a big worry, and this uptick definitely addresses that. This has improved the outlook on stability in a scenario where world is seeing a contraction in narrow money. Higher forex reserves provide policymakers a higher degree of freedom to focus on growth initiatives even in the face of a slowing world economy. With oil prices down sharply from their peak and with cheaper Russian oil mix in India's basket sustaining at a high level, in combination with buoyant remittances and FDI, these are record numbers this year, there is a chance that we see an accretion to USD reserves rather than a depletion over the next 1 year. Quick indicators such as electricity demand, GST collections, etc. are all buoyant. Some discretionary categories such as QSR are definitely showing a slowdown, but this could mostly be on account of more spending avenues opening up as the economy normalizes post-COVID. The past period has seen economic growth being led by the more affluent sections of the society. And sales of high-end goods and services have grown much better. So, for example, SUVs and SUVs versus small cars, expensive houses versus mass market houses, and so on. Housing prices are sustaining, and their sales volumes also continue to be high in spite of higher interest rates. In the coming period, as migrants have come back to the cities and are rebuilding their incomes, their consumption should broaden the overall pie and drive Indian growth forward, while the categories may change over time. IIP numbers for November were buoyant, while petroleum and textiles pulled it down. Metals, pharma, machinery, cement and railways did well. At the same time, inflation is easing both in India and the world, which raises hopes of a slowdown in the pace of increases in interest rates as we move forward into the new year. At this juncture, we cannot have a combination of low fuel prices and high global growth given oil production constraints. Hence, think we are happy with a lower oil price outcome as a consequence of lower global growth, as that saves us a lot of dollars, leading to a much more sustainable combination than otherwise. So, this is the best we can have. Coming down to the next topic, themes, growth themes that we are focused on. We are a process-driven house focused on quality, longevity of growth, and valuation. Themes are a great way to think about spaces that are experiencing growth tailwinds. We as a team have shortlisted a few themes that we believe may do well this year. We have defined it narrowly. So, for example, amongst lenders, we continue to believe that banks could have an edge over NBFCs, while NBFCs could start to come back. Life insurance company stocks may not have performed for some time, and they could get the mojo back as embedded value increases in line with new business, with interest rate up move stopping, and then the embedded value could increase further as interest rates start to decline. Health insurance companies may see strong profits going forward as COVID-related expenses decline. This is a crucial quarter for these businesses, just to decide the outcome of the market direction. The other theme we are clued on is healthcare, where hospitals and pharmacy chains seem a much better way to build portfolios versus generic pharma companies. In urbanization theme, we believe that consumer discretionary categories are better placed than builders or autos or staples. New age companies have shared their intent to focus on profitability, and if they stay on their path, they could also be interesting. Though volatile, as old shareholders exist and shareholdings change over time. However, on the margin, these new age businesses could prove to be better than IT services companies over the medium to long term. China plus one is the other theme. Chemical space is probably a good way of participating there. Along with it, we continue to be focused on Make in India theme, and engineering and defense companies continue to be a focus. One should expect to see margins improve from this quarter, quarter 3 of financial 23, from H1 FY 23 lows as commodity prices have declined, and within the above themes, the spaces where margins improve can have further tailwinds. On budgetary outlook, we will just make a few points. Budget should continue to be growth focused and focused on nation building and infrastructure. Globally, countries are focused on improving domestic manufacturing and defense capabilities, and I think this should help our resolve towards these same objectives. We expect to see stability in the tax regime and expect government to attempt fiscal consolidation. On that, FY24 numbers could be better than budgetary estimates on very buoyant revenue collection, and fiscal deficit could be lower than what was projected. On market related and stock market related taxation, we may see a rationalization of holding periods for the purpose of classification as long-term capital gains across asset classes for the sake of simplicity in tax structure, and maybe the gains and losses from various asset classes could be made fungible. In a period of global fiscal consolidation, I think India would have to put its best foot forward to continue to attract foreign flows in both debt and equity, something which is necessary to drive Indian growth going forward. Lastly, coming down to valuations, at the current juncture on a pre-tax valuation, yes, debt seems to be more attractive than equity as interest rates peak out and then decline. Having said that, Indian equity index has been compounding in line with profit compounding from 1997 till now, and this suggests that going forward one should again expect index compounding to be in line with earnings compounding, give or take, as we go forward. Over the past 2 years, we have seen Indian markets being influenced more by domestic flows of money compared to global flows. This we believe is structural And as the per capita income increases, this trend would only strengthen. Domestic investors can invest only limited sums of money abroad, and offshore investors are investing only small sums of monies in the country. In such a scenario, the relative movement of various markets is of less importance, each investor being focused where they would. And hence we expect India to trade in line with its fundamental and be reflective of its earnings growth over a period of time. Now, since Indian economy is expected to grow faster than most economies and profitability has seen an improvement from COVID lows, there is a great chance that over the coming few years, our market outperforms other global markets. While less relevant, I think this stands to reason. In smaller time frames, however, other issues would need to be digested. For example, in the current period, there may be a portfolio rebalancing happening on China reopening, which is causing our markets to be a tad depressed. This kind of FPI-induced selling is a good opportunity for domestic investors because when it stabilizes, the markets are expected to bounce back. It continues to be a time for alpha generation. This is a theme that we have been talking of for several of our last Outlook videos. The times for alpha is good for managers because broad earnings growth and alpha seeking domestic money makes it more possible, in combination with better valuation outside of the index. Our portfolios have had this tailwind and we expect this trend to continue going forward. Thank you. This was on this Outlook edition. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.